I'm Keith McCullough, and welcome back. Hopefully you enjoyed that discussion with a raging free market capitalist and Daniel DiMartino Booth. If you're expecting that I balanced it out and brought on a raging socialist, that's not going to happen here. Certainly not right now with Josh Crumb. So welcome, Josh. You're one of the fan favorites here at Hedgeye. You can span again pretty much anything that people really want to talk about. But one of the big things that you've talked about over the years is, again, just the free market capitalism of it all. So I definitely want to get into that. But before I do, I just want to, Josh sent me this note, and I want you guys to just, his summary of what's going on. Time to restore sanity? Yes. Police state creep gone too far? Yes. All clear? No. All right. Add to that, Josh.
Oh, great. Well, good to be back. Yeah, I mean, I think I always try to add a unique framework, and I think mine in many ways probably aligns with yours quite a bit in that I try to look at this through a lens of sort of complex systems. But I think what we've got going on now, so a lot of people have asked me recently, what is your forecast for gold? What is your outlook? And the first answer, sort of first order, nonlinear system we're in of the existing economy, that's very hard to predict, and we can go over the reasons why, because so much is changing so fast right now. But I would say what's even more complicated when you think about gold, particularly priced in US dollars, is you actually have this, not only do you have a, sort of a tsunami in the real economy, but you've got a hurricane in the financial economy. And as these sort of cross, so I think there's a big range of volatility, even in the first order nonlinear. Mm-hmm. But then if we actually get into where I think gold is headed in a year to two, that's a whole nother discussion. So I'll try to keep it maybe micro as much as I can to be useful and talk about commodity now. But I also want to introduce that because that it's really important to understand where gold and energy prices are going.
And it's also important, your framework is one of the most important things, and I think for everyone that's the most important thing. What is your process? What is your framework? You certainly have one. Talk about the phases of how people feel or resolve their paper wealth versus their economic wealth and where we are today.
Yeah, no, and again, the best way I can answer that question is that I have some sort of expertise or value add is to look at commodity price signals and actually understand and look at supply chains of what's happening in the real economy, and versus what's happening in again sort of the paper economy, if you want to sort of differentiate them that way. And I think what gold is telling us as well as oil, first you have to understand what those price signals are, what that market structure is in these commodity markets. And what you're seeing is obviously gold breaking out to all-time highs. We've now, over the last year and a half, gold has broken out to all-time highs versus every major currency except the US dollar. But I believe this quarter will probably pass the quarterly all-time high for gold, even if we don't, touch that 1900. But we have passed it already in renminbi. So basically every major economy in the world now, gold is now moved to an all-time high. But then I also look, what's very important is the price signals in say oil markets. Mm-hmm. And why this is so important is because it's obviously telling a very different story, right? One is sort of a demand, a demand shock in the rush for gold, and one, of course, is a demand collapse where we actually need to shut in the energy market. So typically, over long periods of time, these markets actually correlate very well. Regardless of your financial system or currency system, and there's a lot of as I've talked about in past episodes, that people can look back on, why that is. But these things are moving in very different directions, and that price signal of them moving in very different directions is actually something very important to understand with what's going on in the real economy. So then we can ultimately get to your question of how do we protect our wealth through this. Yeah,
when you go through that, that signal to me is always, as you know, through the lens of the volatility of the asset price. And it's suffice to say, I mean, oil volatility is trading between 110 or 115 today. You know, for those of you that don't know what that is, OVX, or the equivalent of the VIX for oil, and 180, Josh. Like, I mean, we go back to, you've covered this, and for those of you that also don't know, it's up, his bio's up there on the screen. You know, he used to be a nice Goldman guy, I used to be a nice Carlyle guy, now we're just nice guys. Yeah, and it is what it is, right? It's not like it's our first day on the job. But when you look at this, Josh, I don't know what to say to clients actually about this one, because oil volatility is, you take the chart and it's off the chart, and I wonder what you see when you see that signal.
Yeah, again, very much like your framework, I see that signal as obviously very scary. And what it's saying is we actually don't know where the price fundamentally can be, which to me, where then I jump to is this is extremely dangerous and scary for the real economy and in supply chains. And the reason is a lot of people ask, is the volatility coming from financial markets and transitioning into real economy, or is it coming from a real economy and transitioning into financial markets? It's actually the feedback between the two that is most scary, right? So I've always argued, and a theory that I developed, a theory of backwardation in supply chains that I developed at Goldman, really looked at ultimately is don't get rationed in their supply demand. In my view, they don't get rationed necessarily on price, because commodities are such, particularly natural resource commodities are at the beginning of supply chains. Typically, that price is passed all the way through the supply chain.
Yep.
And so ultimately, the crude product volatility is what really rations demand. And really rations supply and demand. So it's volatility that actually breaks the market or slows it down rather than price. So volatility is extremely important here.
Yeah, well, you've also, and you talked about that in terms of livestock, like people watch the price at the store versus the price of the livestock market that institutional traders and or asset allocators are looking at. Can you talk about that?
Yeah, exactly. And that's the, particularly in agricultural, that is what's actually getting scary. So what we've seen and what we're going to probably see in the next 2 weeks what we've seen so far during this real economy crisis, putting aside the total tragedy, of course, in service industries and hospitality and so forth. But what we've actually seen in the industrial side is mostly a demand surge shortage, right? So whether that's gold or toilet paper or eggs, or there's various things that you see on shelves that have already been made. This is where the consumer or the end consumer is building their own balance sheet or their own store of goods. What we actually have not even seen yet is the supply side disruptions. I suspect, just tracing back supply chains and the way companies generally hold rolling stock and inventories, we'll probably see the first shortages of what happened in China in January only coming through in the next few weeks. Okay. So this is going to be shortage of things like shampoo off the shelf, and that's because we've had all of this the shock and this lag of manufacturing in China, and eventually how these supply chains distribute it to the shelves, right? So, but what we're going to actually start seeing in the next wave of this economic crisis is actually, even though you have prices of raw goods maybe collapsing like cattle futures, because they now don't have the demand in their supply chain. Part of that supply chain was going to packaged goods, part of it was going to fresh goods in restaurants, and so that whole breakdown, it's not easy to reorder that. So you demand of sort of crude commodities collapsing, where at the same time, further down the supply chain, you've got a demand, surge of ultimately that the volatility is going to start breaking down these supply chains. And so what the Fed had to do first is, of course, financial system to make sure we didn't have a third shock to this, which was credit not moving through the supply chains. but unfortunately, we're not going to be able to avoid the shortages in goods. And I really think that's the next wave of the economic shock that will probably start hit over the next few weeks.
Well, we don't see that yet. I mean, you can obviously now cast it, or as we like to do, just take the data points as you get it day over day. And as I keep pointing out, we're seeing the worst rate of change declines in, and I'm talking about time series upon time series upon time series of, again, government issued economic data that we've ever seen. The worst month over month that we've ever seen, and that's March data. Okay, we're obviously in the middle of April and about to go into the next phase of this. How does that work? Like, if you were to put just because you've done, we're going to talk a little bit more about gold, I'm sure, in the Q&A. You talked about oil, but livestock. Like, how does the real world work in terms of real assets when you shut it down? And in the store, you got to pay this much for the meat, and if you own the cattle and you can slaughter it and eat it yourself, you pay that.
Yeah, I mean that's the part that I believe our entire economy, whether it's the credit economy or information economy or commodity economy, these are all scale-free networks. They're all these systems of Pareto type distributions, and ultimately, if I'm at the very beginning, again, the raw material, I'm sitting up here in Muskoka, Canada, the land of the sticks and rocks economy. So we're usually at the beginning of this whole thing. Right, and when you build a new mine, or again, going back to back to agricultural commodities, first you want to have predictability of, call it, 90% of your offtake next year. Right, you want to know who your counterparties are. You know who you want to send to. They need to have good credit. They need to provide you credit in some cases, and usually there's only about a 10% volatility, which is either demand volatility coming down or supply shocks because of weather or some sort of event. So that's how most commodities function. Is you have pretty good predictability with maybe 10% swing. The problem is, by shutting in the economy so significantly, particularly in agriculture, your swing capacity, like, this is where that volatility starts breaking down. Yep. So the person ultimately at the store is not going to get the good as that lag.
Still got him?
Did I lose you?
No, I think we still got him, right? You guys good? Yep, we're good. Yep. Yeah, I think
you still have me?
Yep, we got that. Yeah. All right.
Yeah.
I got that. So now, just to flip a switch and go all the way back to the top, and then we'll come back down. You talk about financialism, #financialism. What does that mean, right, and where are we now?
Yeah. So this is sort of the second part of the storm that I've been discussing. So if we go back to my, the gold money framework that I was developed with Stefan Wheeler and Roy Sabag over at Gold Money, if we look at our framework, ultimately we've got two components that drive the price of gold. One is the energy component, and this is what I would actually call kind of the real economy, or using going back to Karl Popper and George Soros. This is sort of the objective price in the function, which is, again, very much back to those commodity moving real goods fundamentals. The second half of it, the denominator of the gold price, is of course the dollar economy. And the financial economy. So what you've seen in this time is, and even before we had this economic crisis, we'd already started seeing back, really as early as 2018, and maybe even 2017, the euro, call it the euro dollar market, or the dollar economy, and that's because essentially the risk-free rate in the economy, or the risk-free rate in the entire financial system is moving towards zero, right? The yield curve on the U.S. dollar moving to zero is really sort of an end game to that system. So we had already started seeing some real problems in the risk-free market, in obviously not QE and in Q4, and now we've accelerated. So got very bullish on gold after really years of moving sideways, back when we realized that we were approaching the end game in sort of summer of last year. Right, this is when the Fed really, all the rest of their forward guidance moving back towards easing, and of course we saw the first steps of that in not QE. So we think gold is just going to continue to sort of march up from here. But now that we've accelerated what I would call sort of the end game with what's going on in this what's going on this current real economy shock. Is that ultimately the sort of the second order nonlinear is when we actually have to devalue the whole U.S. dollar system versus things like gold and oil. And I think that's now been accelerated forward. And so again, in the very near term, I could see gold, really in the first order nonlinear going anywhere from 1,200 to 2,100, very rationally. Based on just energy and real interest rates in the current system. However, where I think we ultimately come out on the other side is a reset to sort of $3,000 to $4,000 gold, but that also corresponds to $90, $120 oil. So again, I think there's some real inflationary shocks coming, but there's going to be a period of a lot of turbulence before that.
Yeah, I'm sure we'll get a lot of questions on that dollar piece, but just to take a couple steps back on that, I mean, volatility and resiliency, volatility of assets, if it's breaking out, all of a sudden people start to see that it's not quite resilient, it's quite risky. So again, people flow out of assets when that happens. Conversely, when you see something that's resilient, or as I think Taleb would call it, anti-fragile in this environment, they thrive. So the price of gold thrives. Hedgeye against CNBC's thriving, Crumb. These are, you're probably even thriving if you have enough drinks there in the Muskokas. I mean, there's a lot of thriving that actually starts to occur because, if only because you see that the fragility of everything else. And that, I wonder if you could take that to that very basic step further, which is, and I talked to Danielle about this quite a bit, which is why is it that I guess the establishment or officialdom has been so resilient or able to avoid this discussion? Well, they don't look like they're able to avoid it forever. Certainly, forever seems to be getting to be on a shorter leash.
Yeah, well, I mean, I think it really comes back to the bond market, and ultimately, this is probably where you and I agree in what I'm calling this sort of first order nonlinearity of the current system, where bond prices continue to go up, particularly treasuries. But where I actually see the next phase is the inflationary phase where those actually start to go down. So if you look at, back to your question, I think we've got a financial system that's really geared towards the Fed increasingly taking over, or the central banks in general, increasingly taking over the entire economy via the bond market, right? So it's with most important sort of base level of the credit market, which is sovereign and real estate, particularly residential real estate, and that sort of applies no matter where you are, whether it's the U.S. or China. Essentially these are becoming very similar systems. But as we've seen over the last few weeks, and so again, back to your question, I think the incentive of the system is for those prices to continue to rise. Right, so it's a bit like the housing bubble, going into 2008. Like again, this, everybody generally knew it was a fraud by sort of late 2007, early 2008, but it kept going up because the incentives of the system were for it to keep going up, right? Yep. So the as I was told years ago, a wealth manager can't pitch gold. Because it sort of scares people from investing in anything else, and so that's the fundamental conflict, I believe, why people don't want to talk about this.
Well, more people are talking about it. I got to say, I mean, and my friend Steve in Boston at Fidelity, who runs their gold fund, is quite fired up. I mean, again, it took a little while. And Steve's just a beauty, but so cheers to you, Steve, if you're watching this. But it takes a little while, and then it starts to happen a little faster, and then the charts start to look a little better, and then the interest starts to build. I've had many discussions with big cap equity only managers that own Barrick Gold, they own Franco Nevada, some of the names that are a little bit more liquid, and that wasn't as of like last week. As you know, the gold rally started back in October of 2018 when the U.S. economic cycle and interest rates peaked. So that's been something that's been building. This didn't come out of nowhere. You of course know that, but I've been quite encouraged to see that at least the institutional community has had to change a little bit, if only because that's what they have to fight for to beat the next guy.
Yeah, absolutely. But this is where actually I get a little bit concerned because again, the very quick and easy reaction is to bail out the financial system first, which again I kind of understand the worldview and why you need to do that. So that again, so a supply chain moving backwards is a credit chain, right?
Mm-hmm.
So goods come one way, finance goes the other. And so if we continue to have the severe dislocations in the credit markets that we started seeing right away in March, then yes, like this real economy system would have got hurt even worse. So I do agree with that. But the problem is it's also given people in the system that got bailed out first a faster move into things like gold, right?
Yeah.
And I guess where I get really worried is it also gives them so their wealth wasn't as affected as the person that got laid off. And again, it's very hard to get that credit right down to the last mile of the person that got laid off from a restaurant business. But because you bailed out one first, they're going to have an ability to outbid that scarcity of stakes, that scarcity of gold. And so that's where I see the injustice of the system, which of course has been extremely frustrating, even though I know why they have to do it.
Well,
Yeah. So
on that, let's go down
go
that
ahead.
path. I mean, it has been frustrating, and not to get you more frustrated on this, but I thought you put it as well as anybody I've seen put it in print. You called what the Fed and Treasury are doing together basically running a levered relative value fund, and that's that's just great, Josh. Like that's a perfect way to call exactly what they're doing. Because relative value, of course, you're buying all the cheap shit because you have to, so that the cheap shit doesn't become more like shit because it stinks like shit, and that's why it was cheap and getting cheaper to begin with.
Yep, exactly. But the problem is now the banks. So one thing that's actually so far been somewhat encouraging is the health of the banking system, because we actually took a lot of that function out of the banking system since the last crisis, right? But what you're seeing now is you're seeing the CEOs of the big banks lobbying to be able to unwind some of those credit restrictions so that they can take the first-hand liquidity, right? They get to sell the mortgage paper. They get to sell now corporate paper. They get to sell all of this to the Fed. Now they want to be able to buy assets first, and that's what they're lobbying to do right now. Is something that I just find is going to create an even bigger tail risk later. Right now people are generally locked down, but the risk that I see for a renewed surge in our is just it's now becoming the base case.
Well, that makes a ton of sense to me. By the way, I didn't mean to use the word shit, but you did. I would never do that. But the you wrote just new Keynesian pigs rolling in Fed shit. Like, what? That's awesome, man. What? Just can you tell people what you meant by that?
Yeah. Again, I mean, the problem is that the Keynesians, all they care about is aggregate demand, right? It's all about aggregate demand. We've got to create a new, we got to fill that hole in aggregate demand as fast as possible. Who cares the distribution of that demand, and who cares that half of the people can't afford anything right now? We just got to make sure that first we got to fix the credit market. We got to triage all of the bleeding in the credit market, and then second, we've got to maintain aggregate demand. Who cares where it goes? Who cares if the only people that can have aggregate demand are the few people that are in the financial system getting bailed out? And that's the problem. Is the new Keynesians don't seem to care about distribution. All they care about is aggregate demand.
Yeah, big time. I mean, and picking the winners and losers there is incredible at this point. Slide 39, guys, just so that you can show, like when Josh says, or when Danielle says, there's a very narrow piece of the pie that's getting all these goodies. I mean, you can see that. This is the equity ownership I'm showing here, Josh. I don't know if you can see it. A share of U.S. household equity ownership, by percentile of net worth. I mean, we're talking about the 0.1%, never mind the 1%. And if I were to show that, maybe we should get that data for the high yield or junkier part of the credit market and private equity, it's even more skewed. So It is. It's hard, right? I have institutional clients. I don't know if some of them are disgusted with me or want me to be rolling around with pigs and shit right now at this point anyway. But I don't care. I mean, I'm going to keep doing my job, and I'm gainfully employed, so they can't quite get rid of me yet. But what is it, like, wherever you go and who you talk to, what is the level of frustration associated with picking winners and losers on that front?
Yeah, well, I think this is one of the unsaids that's going on right now, right? So, I feel like I was probably a little bit early of the contingent that, left Goldman Sachs, and generally, but at the beginning of the program, you said we don't have a socialist on, and I'm not, but I'm going to say that I was certainly the first wave of the ex-Goldman to watch what's going on and the injustice of the financial system and get extremely frustrated. But what I would actually say is whether it's myself or Stefan Wheeler or a number of people that worked at Gold Money, we're now just about everyone we talk to that's inside Wall Street. They're like, wow, you guys were right on Gold Money. They're buying gold, hand over fist, when they were laughing at us 5 to 10 years ago. And they're realizing that this is happening. So this is a mainstream narrative. I think more and more, even if you have people in financial media or the political elite not wanting to talk about it, everybody knows it at this point, and they're being ridiculous if they're not calling it for what it is.
Well, it ridiculous remains ridiculous until it stops. I mean, at the end of the day, this discussion isn't happening on CNBC, not even close, and it won't. And this discussion doesn't happen when Mnuchin talks about big checks. Like you got like a lot of stuff going on out there, man. On that, Goldman alum. There's a wide. I have a lot of contacts in that alumni network, and there's a wide. I mean, as wide as I can get almost gap between who is pro bailouts and who is like, wow, this is the end. And I mean, some of the best known Goldman people that anybody knows. So I mean, what do you think about that? Is that the same? Do you see that same gap?
Yeah, 100%, 100%, right? And again, and this is, they, you're supposed to stay in this window and sort of pretend everything's okay. And sure, again, maybe I'm at the extreme, and I'm happy to be at that extreme. But I think what we're going through now, I like to use a a backcountry skiing or snowboarding analogy. You don't just go down the backcountry like, yeah, I'm sure it'll be fine. You have to know what you're doing. You have to know what's going on the mountain. And I think we're sort of separating ourselves from reality more and more because we don't want to step outside of that window where we're confident that everything's fine. And that's been my biggest frustration in the last weeks and why I've gotten louder and louder. Look, I still live and work within the financial system, right? So I'm kind of I'm sort of going after the hand that feeds me, but I think we have to because it's just getting so ridiculous that we need more and more people to actually start thinking about a better way to get down the mountain in the middle of an avalanche, right? We actually start rethinking how we come out the other side and what kind of world we want to live in. I mean, I'm not always negative. I actually look at a lot of very positive things on the horizon. I look at the energy, the renewable energy revolution that's going on. Still a massive wave of technology creating opportunities for the rising middle class. And all of that's going to be put on hold again if we need to create moral hazard to bail out the last system and keep us from regenerating to the new. Right? And I'm sure myself and Danielle, agree on that. We need this regeneration because there's some really great horizons, but we need to talk about reality and actually move to that horizon rather than getting stuck in the past.
Yeah, regeneration, evolution, as opposed to what you're doing, which is basically piling more debt upon debt, late cycle debt, I might add. It's amazing. It's amazing to watch for people like you and I that have grown businesses, tried to think about it differently, and not just thought about it, but actually executed on it. We can go on and on about that, but I want to get into the questions because there are many here, Josh. So if you don't mind, I'm going to start firing off. This question, I knew it was going to be somewhere in the top questions in terms of votes because people have had a very hard time, and to an extent, it's a relative value problem, I think. But I want to know what you think, and that's what matters more here, which is the difference between what's going on here in gold and in silver.
Yeah, so that one's interesting because Well, first off, silver's starting to have, even in the microstructure, the market structure of futures markets, starting to have the same thing as gold, as is palladium, where you're actually seeing a shortage and an inability to get to retail products because of what's going on in the market structure of wholesale precious metals. And what that means is silver price is actually at the retail level because of physical premiums, are actually already moving significantly. And what's going to ultimately happen, in my mind, is the spot price at the wholesale level will follow that. So it's lagging, and the reason it's lagging is because silver really doesn't become a monetary asset until you really get into a level of negative real interest rates, where it makes sense to pay the carry on silver because it's bulky, and so typically the retail that doesn't have the cost of the balance sheet and the storage, or it's a different type of charge, call it, than the wholesale system. So the retail moves first in silver, and we're seeing that in the actual end price of physical silver. But we're not seeing it yet at the wholesale market, but we will.
Yeah, what's interesting, and again, and apologies in advance, and I mean that obviously sincerely, if I don't separate, hell hath seen no fury, Josh, if I don't separate us knowing the difference between paper and physical, okay? So we get it, all right? Now on the paper side, and again, that's been a lot of feedback, particularly on those that are long of physical silver coins fully loaded. It's been a great market to have been long of the physical, and will continue to be, I assume. The thing on the paper is that it started to trade with the same volatility as base metals. And that's what happened. Like, at least that's my answer in terms of the mathematical answer onto the why the divergence. Well, because gold went one way and volatility for silver went the other way. And that other way was probably perpetuated by the machine's view of the base metals asset class, which I don't put gold in that same bucket, by the way. I don't think you do either.
Correct, exactly. So silver has this dual characteristic of a byproduct industrial commodity, as well as a monetary commodity. And again, it really takes certain levels of relative demand for industrial, which again, with the demand for industrial, you've got more supply available to, temporarily to the industrial economy, so it trades like copper. But as more and more we get into negative real interest rates and it shifts to being more of a monetary commodity, at that point you see the surge for the demand for store of value. And again, the difference between paper and physical, it is actually quite important because there's a lot of misinformation on this, what's happening right now. So people ask a lot, is there a shortage of physical gold? And I generally believe the answer is no. There's a shortage at this price, and there's a shortage in the very near term because we've got a really broken market structure between the LBMA and COMEX. So basically, we've got a big short squeeze because all of the physical inventories that are bought, whether it's bullion, investment bullion inventories for dealers, that's hedged out in the COMEX market. So this is very much, very similar to what's going on, what was going on in the Treasury market, where you had these wide spreads in volatility because wholesale inventory was not matching the hedging market.
Yep.
So you had this basis trade that was sort of breaking down. And so I believe there's a shortage of wholesale gold that's being bought and sold at this price. And the market structure for hedging that on the COMEX is breaking down. So yeah, I mean, it's and what that does in the real economy is now everybody's scrambling to mint, or find to close that arbitrage with COMEX. And meanwhile, the people minting blanks for coins or bars or small retail gold, those are spiking because of that arbitrage. So again, there's going to be a shortage at the retail level with higher prices because of the breakdown in the wholesale market.
Yep, that's very helpful. A lot of questions actually on that topic in particular. It's like you're looking at my queue, man. You got some new Josh Crumb technology where it's like you're in there and I can't see you. But there's questions from Matt Hunstock. Also talking about the dislocation between physical and the financial gold markets. How about the transport trade side of it due to the virus on the physical side?
Yeah, that's a big part of it. But precious metals have a particular market structure problem because unlike, say, energy, where there's all these big merchant energy firms that sort of sit between between the supply and demand and close arbitrage, the traffic eras and VTOLs and so forth. In the bullion market, that's mostly done by the bullion banks. And particularly it was done by the largest physical bullion, which was Scotia McCullough, who's essentially exited the market. So they were anywhere between 40 and 50% of servicing the smaller, real economy for gold, and they no longer really exist. So what's left is a couple big bullion banks that are ultimately they should be closing a massive arbitrage, 5-6% arbitrage between London spot gold and the basis trade on COMEX. Or what used to be a basis trade on COMEX. But they would actually need significant balance sheet and expensive and scarce logistics to move the gold from London, melt it, delivered into COMEX. So this is actually a market structure problem, combined with the fact that the bullion banks are really the only ones that can close that arb in any scale, whether it's balance sheet or other reasons.
Good answer, man. Is the and this is this question within the same question, and I have an answer to this. This one kind of annoys me a little bit, but is the physical investor different than the paper gold investor?
Yeah. Again, not necessarily. I mean, the main difference is whether how far you're buying it down the supply chain, right? If you're buying a coin and bar from a local shop, then it is different because you're not buying it at the wholesale level. But those premiums over time just move in line. So right now, yeah, I mean, again, if you're looking for a small amount that you can store at home safely, then it's going to be very different than someone that's buying 400-ounce bars, stored in a vault.
Yeah, I mean, it's I don't know why people get their bees in a bonnet or bonnets in a bee or whatever it is. I mean, I don't know why people feel like you have to be one or the other. I own both. I mean, I don't feel like conflicted or anything about that. I mean, it's like if you understand the volatility of GLD and you can risk manage accordingly, I mean, then have at it. I mean, it doesn't mean that you're poo-pooing physical gold. I mean, I get a lot of that, though. I don't know if you do, if there's just a community of people that consider themselves purists that just won't touch the GLD, for example.
Yeah, I think one other big difference between the retail and the wholesale, too, though, is the leverage in the system, right? So there's for instance, why people even buy GLD versus buying something, something like a bar, allocated bar inside a bullion bank's vault or even your own private vault, is you can get way better leverage on the GLD, right? You can whether you're or obviously you can get more leverage on futures. So if you're looking to play the metal with leverage, then people typically like the stuff that's more liquid and that you can get borrow against. And it's very hard to get a borrow against a 1-ounce coin. So that's the other big difference in the market structure.
Yeah, I mean, I could see where some people get upset about it. I mean, I'll remember the summer of 2011 like it was yesterday on this front. There's a big buzz at my golf club about the gold price. This is, of course, after it hit the all-time high. It was the summer of 2011. I forget what date in 2011 did gold hit its all-time high? You'd probably know that.
I don't. I think it was November or something late in the year, but I don't remember.
So all these Wall Street types, private equity and hedge fund, and so there's a buzz, and people are like, wow, I got to get some of that. I got to get some of that physical gold. So one of the guys who's got he's worth a lot of money, he goes and he gets delivery of gold, and the Brinks truck shows up and brings it, and his wife was there taking the delivery, and she called him, because I don't know, the guy just kind of left it there, took the dolly away, just left it in the driveway, and he was like, he couldn't believe how heavy it was. Yeah, he's like, I'm like, well, how much did you buy? That was the peak, all right? Now that is when the last guy on Wall Street buys physical gold at the wrong price. I mean, that to me was it. But I don't think we're anywhere near that rate now. I mean, that was a legit people, you could go to a Wall Street conference. always make the joke. If you went to a Wall Street Goldman conference, retail conference or something, retailers and super duper cool companies, you could stand outside with a bucket of gold and offer to sell them to people coming out of the conference, financial market experts, at 20 to 35% discount, and they wouldn't pay you. They think it's a heist. You know, like it's like a, so we've come around a long time here, but never quite really has Wall Street understood the cycle of the gold price and or the value of gold, I don't think.
I would generally agree, but I would say that changed in Q4 of last year. So I was actually talking to somebody at the Goldman Macro Conference in Switzerland this year, and they basically said they've never seen so much physical gold moving out of the system.
Really?
So that was actually started. So yeah, exactly. That institutional bank run of gold in Q4 and the unwinding of the relative value trades, right? So that tremor in the bond market in the treasury market that we saw in Q4, that actually already ignited a physical gold run, which obviously just accelerated now. So I actually do believe, and again, like the people like at your golf course, they're there now, and I think they're only going to get bigger over the next. Again, once we get this next wave of supply chain volatility, fear in the economy, and I think that probably hits sometime in May. I think there actually will be more of it, but that's just. I mean, again, this is a total nonlinear system. That's just one way I would map it, but I have no idea. But I think it is coming.
That's interesting. This is a really interesting question. I have no idea what you're going to say on this because I don't even I don't have an opinion. What's your take on tokenized assets, not cryptocurrencies, real assets that are tokenized?
Yeah, I mean, I think this is the future in many ways. So again, this is a whole nother discussion and rabbit hole of again, we have this sort of euro dollar system that's sort of approaching at the end of its useful life. But the problem is we don't have anything to replace it. It's much faster moving. So what's going on in the crypto world? Call it DeFi and decentralized finance. Look, I mean, it's still very early experimental, still round up and go to jail phase. But I think that the technology being built in that space plays some transitionary role of what the world looks like in 10 years. Tokenized, digital title transfer of assets. So, my company is actually investing in that, even though we have nothing to do with crypto. And I do believe that's part of what replaces, the big wholesale Eurodollar system. Is much more decentralized, decentralized finance. And I think we've seen that in technology. We've seen that in information systems and distributed systems. I don't see why that wouldn't come to finance. And in many ways, what we're seeing with another sort of another positive that's happened the last few weeks in the financial system is people are getting more and more comfortable with digital and technology and work from home and digital signatures instead of paper. So this digital transition is going to accelerate. And so, yes, I believe taking title and collateral digitally and moving it around is a big part of the future.
Okay, maybe the last question here. I get this question a lot. I definitely want to hear your answer on it. It's a simple question, really, and it's if GLD can't deliver, then what?
Yeah, so. I try to stay away from that one a little bit because ultimately I don't think GLD is a great product anyways, unless you want the leverage and liquidity of GLD. Ultimately, you're paying 40 basis points a year in management fees, and any sort of liquidation through bankruptcy of your custodian or if any big part of the wholesale financial system starts to crack, take your underlying asset anyway. So and you're paying more for the cost of that for the convenience of buying GLD. So ultimately, I think there are problems there. They're not ones that I would sort of consider immediate, but there's better and cheaper ways to own gold anyways.
Yeah, I mean, to me, it's not even. I don't even think of it as. I never expected. any trade I've ever made in GLD to deliver me physical gold. I mean, I just want to trade the damn thing, just like anything else. I mean, it's not. There's no emotion associated with that. It's just if I want to have like you said, a way with some financial leverage to trade an explicit opinion I have on something that I feel like I have a pretty good opinion on and an accurate track record, then that's what I'm going to do. I mean, it doesn't mean, if I want to actually own physical gold, then I actually go buy that. I mean, isn't that a reasonable answer? I don't, you can make up for a lot of the fees by just trading the damn thing.
This is the same debate that you have in information technology and everything else, right? You trade convenience for security, right? Speed and liquidity for security, and it's just a cost. What's your economic cost, and what's the trade-off?
Yeah, that's why I love what the Roy and Mene, that company. I mean, it's just such a brilliant idea to have what you actually bought in physical gold jewelry to be trading at a real bid-ask price on a screen. I thought that was a wonderful innovation, and hopefully he does well with that. Well, thank you. I appreciate it. The questions were as I thought they would. They'd be great questions, and you'd have a lot of important answers to them. You crossed the gamut here and educated the audience, and that's the most important thing. So thanks for taking the time to do that.
All right. Thanks, Keith. Good to be here.
He's the man. He's Josh Crumb, and now he's gone. So we're going to come back in 15 minutes with Jim Bianco, his first time on Hedgeye TV.